What it does suggest is that we're likely to see a rotation from value back into some of these beaten up growth names now.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the Mercurial Portfolio Manager, Lance Roberts. Lance, how you doing?
Fine, I've not touched Mercury all week. I'm doing better.
Okay. Well, I don't know if it's because Mercury's in retrograde or something like that, but the markets have been quite mercurial. We have seen volatility return. This
Yep.
was one of your themes of this year, Lance, when you wrote your updated article. What this one was about South Park. But yeah, so true to form, beginning of the year, like last year, has started off, pretty bumpy. Let's talk about that. Love to hear what you think is driving it. A couple of big themes that are emerging. As you and I have said or have noted for a good while, the markets have been range bound for a good long while at this point. And I guess one of the questions I'm going to ask you is, at what point do you guys determine that it's consolidation versus topping?
Right.
But one of the big themes that's arisen recently has been the software trade is really starting to degrade here. And it seems to be over concerns of agentic AI, the future of agentic AI, basically removing the moats of a lot of these software as a service companies. Curious to hear your thoughts on that. And also curious to sort of be like, if that's true, how come nobody saw this coming? Like that is probably something, if you've been following AI, like a lot of the
Mm,
Wall Street analysts have, should have come to that conclusion a while ago. Why is it mattering now?
right. Well, so is that where you want to start? I mean, there's kind
Yeah,
of
wherever.
there's 12 questions in there. So,
I know, it's a soup, but they're all related. So just pull whatever you want and go.
well, so first of all, let's just talk about, the broad market in general first. And then I do want to talk about software as a service because I actually just wrote yesterday in our daily market commentary about software as a service. And which was interesting because Goldman Sachs came out and echoed my sentiment today,
Mm.
which I thought was interesting. Just apparently they're reading my work. Not really,
Yeah.
but no. But I think the comments on software as a service are just a function that people are going to start to come around to this reality. Anyway, we'll talk about that in a second. Talk about broad market as a whole. So this week, first of all, we had some rather stellar earnings from the big mega cap stocks. Google, Amazon, in particular, just absolutely knocked the cover off the ball on revenue and earnings growth. They're increasing their capex into AI because that's where the future growth is. Obviously, that's where everything's headed. So, in a vacuum, those were really, really, really good reports. I mean, they're growing, you've got a company the size of a Google or an Amazon growing income and revenue at 14, 15%, sales at 29%. When you're a company of that size, it's very, very hard to grow revenues and sales that quickly. And when you're growing sales, that's something you normally kind of see in a smaller or mid-cap company that's really just starting out and really kind of getting their wind behind their sales. But when you're the size of a Google or a Microsoft or an Amazon and you're growing those revenues at that rate, that's pretty outstanding. And if you take a look, and we've talked about price to earnings growth in these companies, you take a look at a lot of these companies like an Nvidia as an example, they're trading at zero point 0.5 on a price to earnings growth basis. I could cut their earnings growth in half and they're only trading at a one times peg. That's a good value basis for that. So, it was interesting that they had these really great reports, but these stocks were heavily sold off on that news this week. And a lot of that, though, really had nothing to do. Well, the headlines were, oh, we're concerned about their capex spending. We all knew the capex spending was going to be there, but that was not news. That was just the rationalization for the sell-off. The sell-off was really just margin liquidation. We've seen a very big drop in cryptocurrencies. We've seen a big drop in metals this week. And so all those margin calls are getting kicked in. Well, if I've got to cover margin, I've got to sell assets to meet those margin requirements. And the more that I have to sell in my margin requirements, I have to now sell more because now I have less collateral to meet my margin. And it's kind of a self-feeding kind of cycle. And so that's why you saw a lot of that selling pressure this week. I think we might be getting kind of close to the end of it, at least for now. We might get a bounce. We're getting a decent, but so here it is Friday morning. We're getting a decent bounce out of the markets this morning in the same stocks that were getting sold off, like Nvidia's up like 5 or 6% today. So we're getting kind of a bounce in some of those same stocks, which really kind of goes to that idea that that was likely margin covering. Because again, we've talked about here with you and I talked about the rapid increase in margin, the leverage in the markets, the levered ETFs and all asset classes. Everybody were chasing these things. So when you get that price reversion, the great thing about margin is it drives prices higher, but that knife cuts both ways.
Right. As we said, it's bullish when it's increasing
Yeah,
margin debt, but bad when it's
yeah.
not.
Now,
So I do want to talk in a second about
yeah.
what's going on with Bitcoin because Michael Burry came out, stuck his neck out, and said, "Hey, there's this like Bitcoin vortex. It's going to pull everything down with it." I want to talk to you about that in a moment, but just your point about margin calls. Yeah, okay, I can get that, but we did see after the earnings of those companies you mentioned, they get immediately whacked, right?
Mhm.
So so part of that's a reaction to the guidance that the companies were offering. It wasn't just margin call pressure.
I would, yes, that's a fair statement. And again, if I'm looking, so but think about it this way, I'm getting a margin call, and I've got to liquidate assets. And again, we're not talking about retail investors because they don't have any really kind of movement capabilities. But we're talking about large managers that are getting kind of these
Yeah.
calls that are coming in. So when these things come, I've got to look across the spectrum and I'm looking for assets to sell to meet that margin requirement. So as soon as somebody comes out and reports something even slightly negative, that's the asset I sell. And when that price drops, it triggers everybody else to sell the same thing because this is all algorithms working behind the scenes. So yes, the headlines were important, but if you dig below the headlines, they don't really make a lot of sense because these companies are just growing earnings leaps and bounds.
Okay.
But I
So
just
what
think that
were they reacting to? Was
Atlas,
it the size of the capex or what?
a bit of that, but again, that's not new news. We all, the whole big concern has been they're going to cut capex, not increase it, right? And so when you take a look at Amazon and Google, Amazon's going to 200 billion in capex this year. That's they're making a huge bet into the future of AI. And I'm not arguing with people that don't like the capex structure. But in a way, this is good. These companies are investing in themselves. That's what we want companies like Amazon and Google and Microsoft to do. We want them to invest in themselves,
Hmm.
which is what we complain about the buybacks all the time. It's like, oh, they're spending all this money to buy buybacks. Oh, that's great. That's a return of capital to shareholders. That's complete BS. But, we're okay with that. But we're not okay with companies spending money to invest in their future. It just makes no sense. But, that's where we are in the markets today.
All right. And let me pull on that for a minute. So first off, Lance, what the vibe I'm getting from you is sell off probably near the end, and this may actually be a good time to, start entering or taking positions again in these companies. One, because they might get a short-term bounce. Two, because they're investing in themselves, and down the road, this should result in better profits for them. Let me just ask sort of a rant question.
Sure.
What you said makes sense to me, right? These guys are playing for all the marbles, if you will. We want to win the AI future, right? So we want to be the few companies standing that are really owning and benefiting from AI, right? And to do that, you have to be a big company, right? Highly unlikely the days of a couple of college dropouts creating a new AI company in their garage and then owning the world probably not possible in this AI race, just because of the scope of the scale of the resources you need for AI, right?
Be a little careful with that. I mean, Sam Altman, the guys that run Anthropic, these companies came out of nowhere.
Yeah, but they didn't come out of like two guys in a garage. These were guys that were well connected in the industry who
Sure.
raised a ton of capital, right? I mean, you can't start this by borrowing five
Oh,
thousand
no,
bucks from your
yes.
grandma,
Yeah.
right?
Yeah, I'm probably not going to build the next NVIDIA chip in my garage.
Yeah,
That's a
exactly.
fair statement. Yes.
Yeah. So where I'm going with this is, we've ranted at times of um, just the increasing moat in the general retail space, where small businesses are just getting starved by the Costcos and the Walmarts and stuff of the world, right?
Right.
That, Walmart moves into a new town and basically all the local businesses dry up and Walmart gets all the business, right? I mean, I'm glad as an American that most of these big hyperscalers are U.S. companies and whatnot, and if they win, hopefully America's prospects, will rise, continue to rise. But I do worry that, like, are we moving to a world where it's gonna be like five brands and almost nothing else? If
Have
we
you
take
seen,
this out
have you
10
seen the
years,
movie
20 years in the future.
Idiocracy?
Yeah, I mean, kind of. Does Alphabet eventually rebrand as Brondo, and that's that's the world we live in.
Well, I mean, look, two things. And look, this is going to get us into a whole nother rant for someday, but we need to revisit monopoly laws. Um, Monopoly laws were there for a reason. The antitrust laws were there for a reason to keep companies from engaging in activities that kept they kept two guys in a garage from becoming the next Microsoft, right?
Hmm.
And we and yes, and now the antitrust laws look at as well. Google has competitors, right? There's Bing, there's Opera, there's other other internet companies but I think have to revisit this at some point because these companies are now so large that it is, to your point, and I don't disagree with you, it's impossible for new competition and new innovation to really kind of come to market because they control so much of every market share. And I don't know how you effectively address that issue while keeping capitalism intact, because you don't want to move towards more, you don't want to move to a government where government's controlling business, right? You want businesses to grow and aspire on their own. But I do agree with you that that at the rate we're going, the kind of the size and shape of these companies like Walmart, and it's not just Google and Microsoft, right? It's Walmart, it's Costco, it's these companies are so massive that they control such a big market share, it really does kind of minimize the ability for smaller people to compete.
Yeah. So again, we can maybe rant about this in more detail in the future, but I do worry, the sort of investor side and, like I said, pro-America side of my head is like, oh, this is great that these companies are, continuing to lay the groundwork for their continued future dominance.
Right.
But then the other part of my brain is like, is that a world I really want to live in 10 or 20 years?
Well, fortunately, we won't be around, but that'll be fun.
Yeah, I know. But well, before we turned on the camera here, we were talking about our kids. But anyways, all right. Okay, so let's. I know I kind of sent you a little bit off on a tangent there. Do you want to get to Michael Burry's Bitcoin Vortex and how that's impacting everything too, or anything else you want to say on just software before we go there?
Yeah, I mean, we can talk about that. I mean, it's again, when you have, we just saw retail investors. It's funny because I was watching X over the last couple of days, and I'm seeing all these people posting on X where like one kid yesterday showed a picture of his account where he's down $1.9 million in his account. And it's like, well, it says I'm broke now. And I go, and I'm thinking to myself, like, you just blew $1.9 million just speculating in the markets. But there is so much leverage in this market, and all it took, and we've written about margin debt, we've written about leverage, the dangers of
Yep.
it numerous times, talked about it here on the review, is that it's all fine when it's going up, but when something eventually breaks and it starts kind of cycling through the markets, this is what happens. And because once you start getting margin calls in one asset, it leads to selling in other assets that now then those assets get margin calls, which leads to selling in further assets, which get margin calls. And hopefully we're again, if we're through kind of this initial bout of selling, if assets can kind of stabilize here, fingers crossed, then things may stabilize here over the next couple of weeks, and we may start to see some repair in the markets and things kind of start to return to some normalcy. See Bitcoin rise here a bit, see metals recover here a little bit. But there are a lot of trapped longs in these assets. There are a lot of people that were buying precious metals at much higher prices, and they're now trapped in their positions. So when they get a decent rally, they're going to be liquidating. So you're going to have further selling pressure. Well, if you get another round of selling pressure that triggers more margin calls, this is the risk of margin debt, is that it can start to feed on itself. And this is how you can get 10, 15% corrections in markets, kind of very rapidly. And if that selling continues, it becomes more problematic. So, fingers crossed, hopefully this was just a short-term little blip. Things will kind of settle down here. Investors will be able to put some capital back to work here at lower prices, but we'll have to see what happens from here.
All right. So a couple of things on that. One, I mean, yes, there's that risk, and we'll maybe talk more about it in a moment. But I mean, let's be real. Let's look at the S&P. Where is it? 6,900. I mean, it's
About
only
2%.
100 off its all-time high. I mean, it's
Right,
not
right, right.
like the S&P is in any great danger at the moment here. I'd be much more worried, say, like about Bitcoin. I'm a little less worried about the metals,
Mhm.
Lance, and that's because for two reasons. Silver went bananas, as we talked about, but it went bananas really quickly. So I don't think there are that many people who bought above 100. There just wasn't a lot of time for a lot of volume to get accumulated above 100 because it was a couple of days, really, or a week or so between 100 and the 120 top before it came down a lot. So I could be wrong, but I imagine that the average buy-in price for most of the people in the precious metals is either here around 75 or lower. So I'm not too worried about that. Um, Gold seems to be pretty
History,
stable.
history,
Pardon me?
history. A chart price of history of silver would disagree with you on that
Oh,
point.
totally, absolutely. Totally, absolutely. Yeah. But just trying to calculate the amount of positions that were 100 above versus the ones below, I think it's a small fraction of what's owned at 75 or lower.
Possibly.
Now, Bitcoin, bigger deal. It's where it's about 69,000 right here where we're talking about. It got down to close to 60, which really is about half of 50% less of where the Bitcoin high was. And Bitcoin spent more time above 100,000. So I think there you've got a lot of more potential trapped longs. Um, I don't follow Bitcoin that closely, Lance, so hopefully you know more than I do. But we've had the emergence of a lot of kind of Bitcoin treasury companies, and of course the big one, the poster child for all that is Strategy, Michael Saylor's firm, and they were down at some point yesterday, I think like almost 80% from their all-time high, and I think one of the big risks about that, and I don't pretend to fully understand how Strategy as a firm is structured, but is that if it got to a point where Strategy had to start selling Bitcoin, particularly because it has like preferred shares that it's put out there, so it actually has to be paying investors no matter what the price of Bitcoin does. That could be really notable for two reasons. One, it would just be additional selling pressure because Strategy owns an awful lot of Bitcoin. But two, optically, it would be very potentially concerning for the market that the absolute biggest Uber bull in Bitcoin was selling, even if he was being forced to, market putting a gun to his head. That would be
Mhm.
very optically concerning. So,
Now,
how
now, in all
concerned are
fairness,
you about what's going on with Bitcoin, both for the price of Bitcoin, but to Saylor's point of it being this contagion factor that would then spread to other markets?
but yeah, no. Look, I find too. There's a lot of things very fascinating about Bitcoin. One, remember that Bitcoin was supposed to be the anti-fiat currency trade, right?
Yeah.
So great, you're long Bitcoin. The dollar is basically trading near 100. It's down, 11% from its not all-time high, but its recent high a couple of years ago. It's down 11, Bitcoin's down 50. So, the whole debasement trade, all that was complete nonsense. It was
Right.
just
Especially sorry to interrupt, but when gold and silver were exploding because of debasement, Bitcoin was actually losing value. Yeah.
exactly. And then that whole debasement trade fell apart for metals because those are just narratives. We've talked about that before, is that when you get speculative trading in any asset price, it's the speculation that drives the price. So the
Right. All I
narrative.
was saying though is when everyone cared about debasement, Bitcoin wasn't reacting the way everybody thought it would.
Right,
Yeah.
right, right, right. And again, but that's the falsity of these narratives, and that applies to all assets. So, again, set the narratives aside. They don't matter. Manage your risk, manage your portfolio, manage your allocations. That's how you survive the long game. But it's interesting. Michael Saylor says that he will never sell Bitcoin. Bitcoin going to zero, and he's not going to sell it, which I think is stupid. But you know, I'm gonna write it. I would never write an asset down to zero just on a theme. But I think his shareholders are the people owning the preferred debt and the people owning the shares and all that. I think ultimately he's going to have to, he may. I could be wrong, but I think ultimately he's going to be held to account by his shareholders at some point. There's
Right.
if the price keeps declining. Now, if the price rallies right back up to 100,000, which if you take a look at a lot of the previous halving charts and all this is the ones kind of running around right now. It's like, oh, every time we have these halvings in the market, then Bitcoin, then it goes to all-time highs.
Yep.
Then he's fine. He'll be fine. MicroStrategy will be fine. All that. I don't really understand his long game, but it's he was a software company. Now he just owns Bitcoin. So okay, great. There's a little bit of a difference. If, for instance, if I own Solana, if I'm going to be a treasury company and I own Solana, I can stake that and I can stake that currency and I get revenue participation on the transactions of that. I can't do that with Bitcoin. So great, I've got Bitcoin on my balance sheet, and then I'm just now looking at this from a business perspective. Great,
Right.
Bitcoin, it generates no income or revenue, right? So what's the point of me owning it? The point of me if this was my company, I would be trying to buy Bitcoin here somewhere, and then when it got to 100,000, I would be selling it, taking in those gains, distributing those to my shareholders, and then wash, rinse, and repeat that cycle over time. I don't really understand his philosophy of just sitting on it.
Well, I'm sure you're going to hear from people in the comments who probably are closer to his philosophy, and
Sure.
there it's a philosophy, or it's uh, an expectation that this thing's going to be worth $1 million a coin or whatever, right? Yeah.
And maybe that's the case, but he says he's never going to sell it. So even if it gets to 1 million and he doesn't sell it, what good have I done my shareholders? Right. So I mean that's the only problem I have. I mean, I understand what he's doing. I get what he's doing, right? Because this is the whole treasury company thing.
Right.
I get it.
You're saying if there's no exit strategy, why would you ever invest in a private fund if it said we're never going to, have an exit?
Right. Yeah. I'm never going to give you your money back. Okay,
Yeah.
great.
But I guess in this case, though, because it's a publicly traded company, you can have an exit whenever you want as a shareholder, right?
In theory,
Yeah.
yeah. Right. So, that's the other side. Anyway, that's a debate for another day. Um, but yeah, I mean, look, there's certainly things going on within the markets, and the bigger point of all this is we have talked about this previously. This is why we talk about, forgetting narratives, taking profits, rebalancing risk, because these things happen. And when you have highly volatile assets and they're all correlated, they can all become uncorrelated very quickly at the same time, which is what's been happening as of late. So there's really been no. I saw an interesting X post yesterday. Is like Bitcoin's down, silver's down, gold's down, stocks are down. Where am I supposed to be putting my money?
Right.
You know, that's what happens when you have highly correlated assets. And this is why you and I have had this conversation. Like, be careful chasing assets that are all highly correlated to each other, because when they
Right.
reverse, they're going to reverse at the same time.
Right. When correlations go to one, be careful. Yeah.
Yeah. And so, I got a lot of hate for that. It's like, oh, you don't know what you're talking about. Well, I've been in markets long enough to understand how markets work.
Yeah. And by the way, you and I have gotten some nice props from folks in the comment section here over the past week for our cautionary guidance about what to do with the precious metals when they were, shooting the moon there.
Right.
So anyways, just know that not everybody hates you, Lance.
There's one.
Yeah. Well, okay. So back to Burry's thesis here. So let's just assume for a second that this isn't the bottom for Bitcoin. Right? And I don't know if it is or it isn't. I'm not rooting for one way or the other, folks. But let's say Bitcoin, halves again, right? Let's say Saylor actually is forced to sell some, right? Is that just bad for Bitcoin holders, or do you potentially see this as a contagion that takes other parts of the market down with it?
It will take other parts of the market down with it. Because of the leverage, because of sentiment, because of other stuff that's going on. And remember, most of this is driven by a lot. We have just so much speculation in the markets. We've talked about the margin debt, we've talked about the leverage, we've talked about the 2x leverage ETFs, the 3x leverage ETFs. we've got, retail investors that are piling into leveraged ETFs on margin in their account and borrowing money to do that. So, it's just we've reached that kind of point of peak speculation to where if we get more selling, it's going to become a contagion across the markets because again, there's fewer and fewer exits for people to get out of the market. So that risk is going to run high. And this is why, like for instance, ever since the beginning of the year, we've had this huge, we were, last in the mid-November, early December, you and I were talking about the fact that we were buying value stocks in our portfolio because everybody hated them. Nobody wanted value, and because we all wanted growth. And so why would I own a value stock that's not doing anything? Oh, Procter and Gamble sucks. Why would I own that company? Well, those have done fantastic this year, right? So there's been this rotation into value. So now value is extremely overbought, and now growth is extremely oversold. So we may be actually setting up for rotation back into growth out of the value trade. So that doesn't mean tomorrow, but those are the things that are occurring in the market. We're getting these rotations across markets very quickly, and so it's becoming much more important for investors to pay attention to how they're allocated
Yeah.
and be thinking about where is money going to go to when something becomes unbuckled. And that's going to be the thing that will save you if what you're expecting occurs and we have this broader market meltdown, then where is money going to go? It's not the old Wayne Gretzky kind of a statement where he
Skate to the
says,
puck.
skate to where the puck's going.
Yeah.
I think that's where we need to be thinking about is where's this puck going next?
So, we've said for a good while, Lance, that the environment seems to be shaping up to be one where an active strategy is going to be superior to a passive strategy. And in the type of market environment you just described, where it's kind of water sloshing back and forth or liquidity capital sloshing back and forth between different sectors, I think that just becomes even more so. And you're nodding as I'm saying this. To your point about uh, uh, and you didn't use the word fragility, but I think to a certain extent you were talking about that with the market because of the margin debt and everything. And we didn't mention valuations, but that's part of the story here too. When you have valuations that are as extreme as they are right now, things become more unstable because it's like pulling the rubber band, right? When it gets to its max point, there's a lot of tension there. It really wants to move. Um, and when you have a ton of margin debt, the system becomes a lot less stable because anything that spooks people, even a little bit,
Right.
has an outsized effect, right? Because everybody feels, oh my God, I'm so exposed by all this leverage I have. I got to take action right away, right?
Mhm.
So, I think about it like, the market is sort of on a tightrope, but it's on a tightrope that we've been raising up into the sky, and maybe it's now like a mile or two high. It's being buffeted by winds on either side,
Yeah.
and so it's very it's it's very the stability is very fragile, right? In other
Mhm.
words, and that's why the market seems to swing real quick from extreme greed to extreme fear. It doesn't spend
Right.
a lot of time in the middle, right?
Exactly.
And I think it's because it's like either everything's working, like you said, margin debt's great when things are going up, but with a whiff of uncertainty, all of a sudden everybody's totally freaking out. And so that's just the state of the markets that we have right now. And what I'd love to see is the tightrope be brought back down to earth and then maybe become less of a tightrope and more of a pathway, right?
What you mean go back to like 8% annual returns? That would be so boring.
Yeah, I
I
know.
mean, who wants to invest in 8% returns? It's funny, just I haven't said that, real 2 points. First is that, you know, so much of this market is now tied to algorithms that when everything moves in one direction, the algorithms just tack on to whatever the momentum is, and they're all chasing the same assets. So,
Right. And it happens wicked fast.
and it does. And this is why you see things like silver go completely vertical because once the speculators caught onto that trade, they were just piling all into it. And again, we saw this across retail, professional as well. I mean, everybody was chasing the same assets. So that volatility is not going away. Unfortunately, that's not going to go away. So I think it's really important that as investors, we start to rethink how we're managing our portfolio. It's great to chase risk assets, right? It's like, oh, this asset's going up to the moon. I want to get in all, I'm going to overweight, this asset, whatever it is, because it's going to the moon. And that's fine. It works. That's all great until something breaks and you lose a very large chunk of capital very quickly, which sucks. And it, and this is why it's important. I think as investors, we need to start thinking about what's enough, right? We need to start thinking about I'm okay if the market goes up 20. That's okay. I don't need to get a 20% rate of return. I just need to get enough to meet my goals without having large risk to capital drawdowns that impair my future returns. Look, if I'm a hedge fund, I've got no time horizon. My hedge fund's going to be here for 500 years, right? This is the Warren Buffett analogy. I'm going to buy Occidental Petroleum today because I'm going to hold it for 100 years. He'll be
Hmm.
dead, but Berkshire Hathaway will still own it. As retail investors, we don't have that option. Our duration is till we retire or die. That's our duration of our hold. So we need to be thinking about our portfolio in terms of duration rather than risk taking and speculation. And I bring all this up to bring up this chart. I posted this chart on X this morning, and I think this really kind of encapsulates what we're talking about. This is the 5-year return of some various asset classes. So if I owned the Magnificent Seven, I had a 218% return over the last 5 years, outpacing gold, which was 164%. The Nasdaq was 82, outpacing the S&P 500 at 75. Bitcoin is only up 73% in the last 5 years, and
Hmm.
Bloomberg Commodity Index is only up 40. Now, here's my point though. If I own Bitcoin, I've got to have, that was actually up a lot more before the crash, obviously. It was up there with gold. So, but in order to sustain that 5-year rate of return, I've got to accept a lot more volatility. However, if I can just be happy with, listen to this, 15% a year. Now, if I said, look, I'm going to give you an asset that's going to give you 15% a year, are you going to tell me that's not enough? That that's not good enough for you to reach your goal? But 15% a year is what the S&P 500 has given you over the last 5 years with a lot less volatility than gold and silver and Bitcoin and the Magnificent Seven. Yes, you got higher returns with these other assets, but you've got to take a lot of risk on to get those. And this is why, when we start talking about rates of return over time, and start thinking about how we structure portfolios so that we can survive the long-term game, that's the more important thing.
Yeah, you're going back to our conversation from last week, where I complimented you on how unsexy and how boring you were, Lance, because that's what does it. And of course, as you're
That's right. My
saying,
wife
look,
says exactly the same thing.
yeah. um, and just to be super clear, I think folks get the message, but you would say, hey, look, if you can just bend over and pick up, a 25% annual return with no risk, absolutely do it. But you're
Sure.
saying it's all about the risk-adjusted return here, right?
Right.
And I agree with you. I mean, look, and I think the markets have. I'm concerned that the markets, even the quote unquote safer route, like owning the S&P 500, Lance, um, they have been delivering outsized returns.
Yeah.
Even with a decent amount of safety over this period of time, but given valuations and everything we've talked about, the projected returns are a lot lower. I'm just afraid that
Yeah.
there are people who are saying, no, Lance, I get it. I'm just going to hang out in the general indices and I'm just going to collect my 15% for the next 10 years and I'm going to be able to retire on time, or I'm retired and I'm just going to,
Mhm.
count on those 15% returns every year to fund my lifestyle. I'm concerned those people might wake up to a future where they're like, oh, geez, not only is it necessarily single digit returns, but sometimes those single digit returns have a negative in front of them, right? This
Yeah,
is not the decade I expected.
exactly. And look, that's going to happen for every single asset class. Over the next 10 years, every single asset class is going to have potentially lower returns than what they've had over the last 5 years. It could be the liquidity issues, it could be economic recession issues, it could be a whole variety of things. But yeah, I mean, you're absolutely right. And I've showed this chart before. If you take a look at the return, and let's just use the S&P 500 just as an example. So going back to 1900, if I look at the rate of return from 1900 to present, it's about 8% a year, which aligns with economic growth, dividends, and inflation. That's because
Hmm.
that's how you get to your return structure. It's dividends, growth, and inflation. Um, but since 2009, we've been returning 12 to 13% annually since 2009. So we've got a 50% increase in the average annual rate of return than what we had over the last 125 years, right? So something's definitely different. And that's all the liquidity, zero interest rates, monetary interventions, speculation, the rise of the retail investor, the rise of passive index ETFs has all pushed, returns of these markets substantially higher, you know, to really levels that are far outside what economic growth says these returns should be. So again, economic growth, dividends, and inflation should be around 6 to 7 to 8% returns, not 12, 13, 14, 15.
Hmm.
But that's what we've gotten used to. And this is what investors are used to. It's like, oh, and this is why I said if we ever go back to 8% returns, everybody's gonna be like, this sucks, right? The 8% returns, this is terrible. But that's kind of really where markets should be. We should not be generating these levels of returns that we're generating now. And yeah, my fear is just like you, that in the next 10 years, we may all look back and say, well, returns over the last 10 years have been absolutely abysmal. We only cranked out 6% a year.
Yeah, I mean, my concern is zero. I mean,
No,
that's
no, yeah, sure, it could be
yeah.
less.
Yeah, I mean, and you've seen the same charts I've seen
Oh,
that
yeah,
basically say it should be close to that. So, Lance, you're making me think we should probably do either one of these weekly recaps dedicated to this, or maybe even do a dedicated webinar. Maybe bring in Danny and Richard, the personal finance gurus on your team,
sure.
but to do a section on retirement in a lost decade. Right? What
Mhm.
happens if you're already retired or you're planning on retiring in the next couple of years, and then you get a 0% average return, annual return for the next decade? Um,
Like all those people did back in 2000.
yeah, and like I think you think is
Sure.
probable going forward,
Yeah.
not guaranteed, but more likely than not.
Yeah.
So how do we help those people, figure out how to still soldier through without having to, sacrifice too much or be too unduly surprised?
And look, look, I'm happy to do it. Richard and Danny would love to do it. So put a question in your chat and have people respond to it. And if there's interest,
Well, I'm
love
putting
to
a
do it.
question in the video here. Folks watching, if you want to
There
see
you
this,
go.
let us know in the comment
There you
section.
go.
And if it's strong enough, I'll do it. But I actually think that would not only be a real public service, but I think a lot of people, again, people who watch this video tend to be a bit older. I'm guessing it's on a lot of their minds.
But you have to, but again, and I agree with you, but you have to enter that with a mindset of not this is absolutely going to happen,
I agree.
but what if
What if?
that should happen?
What's
And
my plan if it plays out this way?
yeah,
Yeah.
because again, too many people are right now is like when you mention that, you say, oh, the next decade is going to be 0% rate of return. They're like, hooey, right?
Mhm.
That doesn't happen. Markets do 15% a year. That's the new norm. Um, and maybe that's the case, but this is why we are very passionate about actively managing our portfolio, rotating between value and growth. That's why we talked about rotating to value previously. We're now about to make a rotation back to growth. We can talk about that, but that's how we think we navigate the next 10 years, regardless of what benchmark returns are.
Okay. All right. Well, we'll look to see what folks say, and then I'll plan accordingly.
Sure.
All right. I still got a couple of big topics I want to get through with you.
Understood.
But I guess before I make sure we don't skip over it, can you just pull up the latest S&P tape, and let's just
Sure.
get your general thoughts on, kind of what you think is going to
Uh,
happen in the near term?
not run, don't run away.
Yeah, exactly.
Run away. Okay, so yeah, S&P's actually, we talked about, let's see, I guess what was this, Adam? 2 weeks ago, we talked about this orange triangle.
Yeah, and it's still not regaining it.
No,
So,
no, not yet. Which is important, right? That rising trend line acted as key resistance to that previous rally, and we've now sold off and have touched the 100-day moving average, bounced off of that here. Now we're talking about on Friday. Markets are trading very nicely right now. Markets are up about 147 on the S&P 500. Take a look at the heat map. It's Nvidia, Apple, Microsoft. A lot of the semiconductors got really beat up recently, doing well. Eli Lilly, which had boomer earnings this week, along with AbbVie, they both got hit right after earnings, and now people are starting to buy those stocks. Walmart has been just on fire lately. That's part of that value trade. Financials doing well today also. So we're seeing money coming back into the market. And this is why a lot of this felt like last week, or this past week, a lot of this felt like margin liquidation because stocks with really good earnings or really good fundamentals were just getting kind of sold off at random. Like RTX, Raytheon Technologies was down like 4% yesterday for just kind of no reason. So it literally looked like where people were being forced to liquidate and they were just kind of selling assets, as needed to meet margin calls. Maybe I'm wrong about that, but that's just what it felt like this week. It
Hmm.
was just kind of very random as to what was getting sold off
Yeah.
and why. Anyway,
Indiscriminate. Yeah.
and that's a great word. That's the word I was looking for. However, let's take this chart off. Let's take this off for just a second and take a look at this a little bit differently. Um, so the market just really we kind of just go back. We just kind of keep trading in this kind of range. We're trying to progressively make, some new highs and we just kind of fail there. And then we come back down and just kind of keep trading in this sideways range. So the market really hasn't broken down. From a momentum basis, we've worked off a lot of that previous overbought condition. So, that's kind of working itself into a better place. We're not oversold yet on a momentum basis, but we're certainly much more back to neutral than we were. Relative strength is also kind of working itself off as well. So, again, the market's not falling apart by any stretch of the imagination right now. Certainly been some pressure this week. 3 ugly days in the market certainly didn't feel good. But to your point earlier, we're down about 2% from the peak. We're down about 1% now that the market rebounded on Friday. So, the market's not ready to let go just yet. We are watching this very carefully. And if we do take out this 100-day moving average, then that will be kind of key support that will potentially bring the 200-day moving average, which is at about 64.80, into focus. So there is definitely some downside risk. You should not be, dismissing that risk by any stretch of the imagination. But for right now, the market hasn't signaled anything to that real degree that, oh my gosh, I really need to start getting out of assets and start going much more to cash. It feels that way because of what we saw in pockets of the markets, but the overall market was really rotating internally from that kind of growth into value hiding out there. And as we talked about, particularly in today's daily market commentary, we were discussing this whole whoops, this is the wrong one. 1 second. Talking about this whole value to growth trade, and we had talked about this rotation into value previously. And now, if you kind of take a look at MGK as an example, this is a chart of MGK. So MGK is the ETF. It's the Vanguard Mega Cap Growth Index, and just jumping on me. 1 second. So that's come down and yesterday touched on this 200-day moving average. So even it hasn't really broken down yet, but you've had a really big correction. This is a weekly chart, by the way. So sorry, daily chart, but you're pretty oversold on a relative strength basis. So you're kind of getting to that level where it won't be surprising to at least see a bounce in some of these mega cap stocks. And this is particularly the case when we take a look at value versus growth. So this is the Vanguard Value ETF versus the iShares S&P 500 Growth ETF. That that ratio, which is the red line, is now at this is a weekly chart. This is now as overbought as it's been at previous peaks, to where you see that. And again, that doesn't mean value crashes. Doesn't mean go sell all your value stocks, maybe stretch the imagination. But what it does suggest is that we're likely to see a rotation from value back into some of these beaten up growth names now. Because again, when you take a look at earnings, that story hasn't changed. And I think at some point, the market's going to start to refocus on those fundamentals. And this brings up an important point. You and I had talked previously that earlier this year, I wrote a couple articles that earnings expectations this year were way too high, and those expectations had to come down. What you have been seeing is those earnings expectations coming down, which is then causing markets to have to reprice stocks because of valuations. We've seen all that. We've seen those valuations come down. We've seen those expectations come down. So now those growth stocks are in a much better position going forward as they report earnings that are in line with more realistic expectations. They're going to start potentially start performing better.
Okay. So very helpful. Um, I guess back on the general S&P
Mhm.
chart with that wedge, and you don't necessarily have to bring it up unless it's easy to do so.
It's easy.
Um, Tell me are there key indicators that you're going to look at to determine the question, is this something that's been consolidating that it's now all of a sudden about to break out higher? Or is this a year that's going to look more like 2022, where there was a prolonged topping process going in from the previous year, and then things started to break down?
Um, so first of all, yeah, what we're looking for is we're looking for major moving averages. So for instance, let's just go back to last March, right? So this is the decline in last March and April over the whole Liberation Day issue.
Yeah,
So we had a very similar kind of consolidation process going on in, kind of December, January, February, March. And we were warning back then that 3 to 5% correction, not out of the question at all. And, we were just kind of waiting for that to happen. And so you started having this correctional process. And then we started reducing exposure in really kind of late March, early April. We started kind of cutting, sorry, early March, mid March, started cutting exposure because we started getting these moving averages to cross over. And those were triggering more important sell signals that suggested the risk of the market. So, yes, the market was down off its peaks before we started aggressively reducing exposure, but that's kind of part of the process. If you're going to invest,
right.
you've got to accept some volatility along the way. But that analysis helped us avoid a big chunk of that decline. Now, down here on April the 7th and 8th, we started adding exposure to the portfolio because we had not seen sentiment and allocation levels at such low levels since the financial crisis. In fact, I even wrote an
Right.
article. I go, you have not seen sentiment this negative since the 2008 financial crisis, and we're only down 19%, right? And so that was really a good indication that it was time to get some money allocated back into the markets, and that's worked fairly well since. Right now, sentiment is still very bullish. Positioning is still very bullish. We haven't broken that yet. So if we start seeing these markets break down, start seeing the 20 cross the 50, we're gonna start reducing exposure. Now we're not gonna go, hugely negative and like short the markets or anything, but we're gonna start reducing that exposure until we get a better feel for where the market. Are we gonna have this type of event where the market corrects and then takes off running again? Or is it something that leads into a broader, more extended, more protracted correction? That'll take some time to figure out.
Okay. And then how about on the upside? Is it just, hey, if it gets back into that wedge and moves higher, that's a breakout for you? Or is there anything else
Now,
you're looking at to say, hey, this is time to actually increase exposure?
you have to break out to so you'll need a breakout to new highs, a retracement back to the previous highs that holds, and then a move higher that then breaks out again. That second breakout's your go long, go back to the
That's your
market.
buy signal?
Yeah,
Okay. All right. Thank you. That's very
sure.
useful. All right. So I want to talk about two pieces you've written recently. One is market cycles driving 2026 action. Is there anything more to say about that piece that we haven't already said here yet?
Well, no, that is actually talking more about the 10-year cycles, the presidential cycles. We've got a midterm election year this year, so
Which tend
going
to be
in.
bad, right, for the markets?
Well, they tend to be weaker years. Not bad, right? But market
Well, the
returns for
weakest
the
year of the
year.
4-year cycle.
Yeah, yes. There. I don't want people to walk away from here going, Lance said the market's going to
Yeah. Okay.
crash. So, but no, the midterm election years tend to be weaker return years than the other 4 years of the presidential cycle. The sixth year of a 10-year cycle also tends to be one of the weaker years in terms of returns, just on a statistical basis.
Okay.
There's
And 6-year meaning it's 2026 out of the decade of the
Right,
2020s, right? Yeah.
correct. And so that also suggests so again, these are just statistics that don't mean anything other than they're just statistics. It's just something to consider that when you start looking at the fact we've had 3 years in a row of near 20% returns, and which, by the way, those cycles, the first year of a presidential cycle tends to be one of the strongest years. The fifth year of a decennial cycle tends to be the strongest year of the decade. So those kind of returns last year were all very much normal for what normally happens. But again, when you kind of backstack, 3 years of 20% returns, these cycles start to suggest that, maybe we need to be, kind of curb our enthusiasm, so to speak,
Hmm.
for 2026. And look, I just think there's a lot of risk this year. I think this whole reflation narrative is at risk. If you take a look at the employment data, or ADP, Revelio Labs, which does a employment type projection that tracks fairly closely the BLS employment report. We were supposed to get the BLS employment report on Friday. I think it's going to be released on Wednesday, if I'm not mistaken. Um, that's going to probably be pretty weak, maybe 20, 30,000 jobs. It's very difficult for me to buy into this reflation narrative that this economy is going to go surging off to the moon with no inflation if you can't have employment growth. Wage growth is also declining across the deciles. That's also a problem for the
Okay.
reflation story. Look at a 3.5% savings rate. That's a problem for the reflation story. So there's some problems to that narrative this year that I think we need to be at least aware of. I'm not saying that we can't have reflation. I'm not saying it can't happen. Everything's awesome. But I just think there's more risk building up than not. And I think that feeds into that whole kind of cycle story anyway.
Okay. So I was going to go to reflation right after that. So I want to note that I think on the day we're recording here, Lance, we just got the latest University of Michigan consumer sentiment data,
Mhm.
which is actually becoming more positive.
Yep.
And their inflation expectations have just hit a 13-month low.
Yep.
So they're continuing to decline there. So, I mean, these aren't happy days here again sentiment levels, but they're definitely off of the lows and improving here. So, I hear your point about, without the labor market really kicking into higher gear, maybe it'll be harder. Um, but, on the flip side of that, if there's greater productivity coming from AI and technologies, who knows? Wage growth might be slowing, but wages have been real. We've had, it's still positive real wage growth.
Yes, it is.
So
But it's
people are
declining.
slowly getting ahead, right?
Right, right. But that rate of growth is declining, and that's the more important factor.
Okay.
It's
And,
not that
look,
they're positive, it's
yeah,
the rate of change.
yeah.
Yeah.
I'm not declining. I'm just saying
Yeah.
that, I wouldn't count the reflation trade out yet.
Well, no,
And I don't
no.
think you necessarily are. Yeah.
Right. No, no. But here's another reason that, and again, I'm not counting out the reflation trade at all. But there's a lot of expectation built into the market already. I mean, you take a look at basic materials, industrials, energy, they are extremely overbought. They've had huge runs in the month of January, well outside their normal return ranges. And that's all based on that reflation narrative. So when prices get too far ahead of the narrative, when the narrative becomes reality, whatever it is, it tends to be more disappointing.
Right.
And
Well,
so
that's
that's where you
that's
get
right. It's the
correction.
sell the news, right? Even if it
Yeah,
happens,
correct.
expectations have just been built up too high, right?
And that's the point of my articles, which is, hey, let's just kind of calm down here a bit.
Okay. Well, so let
And
me let me let me ask you this. What is more your point here, Lance, which is that you're not sure the reflation that reflation is going to happen, or is your point more reflation may happen, but the stock market may not have a party
my
because of it?
my point is twofold. One, that so the article is a bull bear case, right? So I lay out the bull case for inflation, then I'll just lay
Yep.
out the bear case as well. My biggest question is this: how can you have economic reflation without inflation? This is the big question, because inflation is a function of economic activity and growth.
Hmm.
You can't have, and if you're having reflation, which is this massive increase in economic activity, that how are you going to get that without increasing wages? And if you don't increase wages, which is a function of supply and demand in the economy, you're not going to get inflation. So what they're saying is we can have growth, but nobody gets a wage increase, and you're going to have no inflation. That's not really reflation in terms of an environment that I think plays out well for earnings for companies.
Okay.
Because again,
Yeah.
remember, earnings come from economic activity. And here's something I'm
Right.
watching very closely right now. This is a chart of Truflation. And so the white line is Truflation. And that's for the last month and a half, that thing has dropped like a rock.
Yep.
The yellow line is CPI, and the green line is personal consumption expenditures. These all, and what's important is these all have a very high correlation. They track very closely. PCE tracks with a lag. And what this is suggest if Truflation is real, right, and they track like a million prices and in real time. So, but if Truflation is saying what it's saying and it's actual, this reflation narrative has a problem because that's not reflation, that's disinflation. And if that's what's going on with CPI, that means PCE is about to come down sharply with it. That's my
Maybe,
that's my
maybe,
problem.
but reflation is growth without inflation, right? Doesn't mean you
Correct.
can't have disinflation and growth, right?
Well, where's your growth coming from, though? Again, so what is economic growth? Economic growth is 70% that green line, right? 70% of economic growth is
Is
personal
consumer
consumption
expenditures. Yep.
expenditures. Okay.
Mhm.
So you mean to tell me that 15% of GDP, which is business investment, so that's all the CapEx, so that 15% is going to drive the entire economic growth of the country and forget about the 70% weight that's sitting there in consumers that are just struggling to make ends meet.
Yeah, I don't know. And as we talked about, I think it has a lot to do with what the top echelons do, whose, spending is a very outsized part of the consumer spending
Yeah.
landscape. And I just interviewed Danielle DiMartino Booth, who thinks that that top leg of the K is starting to weaken. So look,
Yeah, there was actually a very interesting, let's see if I can find that chart real quick. There was an interesting chart on that this morning, as a matter of fact, that shows that the bottom 50% is now catching up to the top 50% in terms of spending. So in other words, Daniel's right, is that top 50% is starting to slow down their consumption, which is potentially problematic.
well, I don't think it's potentially problematic. I think if that's true, it for sure is problematic.
Yeah.
Um, but we'll see. And look, part of this too is just me keeping an eye out as I've watched, closely what the administration is doing and saying, I think that they're probably very happy to make the trade-off, Lance, of growth now for inflation later.
Mhm.
Just in other words, get us through the midterms and anything else we'll figure out after that.
Yeah, I think that's dangerous, but yeah.
Whoa. When's the last time, politicians have done things that we liked, right?
Exactly.
Yeah. Um, okay, so TBD, but obviously folks will be tracking this. And again, just one of the things I want to echo, just in case it comes to pass, I want to make sure that folks can say they were warned. Um, I have no clue, what the markets or the economy are going to do for sure this year, but I can see potential for economic growth coming in, surprising to the upside. That does not mean that the markets necessarily have to do that. And I'm increasingly open to a year where GDP grows, but the markets maybe close lower than they are right now. I'm not saying that's going to happen, but I'm just saying don't be shocked if that's what happens. All right,
So
Lance, go ahead.
real quick before you jump, here's that
Yeah.
chart I was finding
Oh,
for you.
yeah, yeah, yeah.
So this is what this chart shows. I can't really enlarge this, so I'm sorry. This is from the Daily Shot, but this is showing. So this is the global consumption spending percent of total. The poorest 50% are now exceeding the richest 1%.
Okay. But this is global. This is not US
Yeah,
specific,
not
right?
just U.S., right? This is global also.
Okay.
But the whole point is that even global GDP is still driven by consumption, right? And so if the top 1% that's been driving 50% of the consumption is slowing down, that's a problem.
Right, right, right. Well, so this is super interesting, and I'm gonna try to track down some slides or some charts of what's going on in the U.S.
Mhm.
Because that seems to be a little bit at odds from the data that I've seen in the U.S., which shows the top 10% usually is the chart
Yeah.
I've seen that their half has been growing, and I just wonder if that's because the U.S. is a little bit different from the rest of the world, or if there's a different explanation.
Yeah.
Um, Okay, so part of that too is the world is gentrifying, right? We are pulling more people out of poverty over the past
Mhm.
couple of decades. More people have been getting pulled out of poverty, not necessarily living lavish Kardashian lifestyles, but going from living in a mud hut to a place with a tin roof and you've got a scooter to get around and stuff like that. So I can see that lifting the bottom 50% materially over time.
Yeah.
But anyways, we'll see. Like I said, I'll go try to track that data down. All right, Lance, I want to get your opinion on another interesting concept that was raised on Thoughtful Money this week. So you're familiar with Mike Green's giant mindless robot, right?
Mhm.
The passive bid, right? The passive capital flows that just come in. They're price blind. They just buy the markets every month. Um, had David Hay on, and he's a big fan of Mike Green's, totally gets the giant mindless robot. He's just saying, I actually think there's maybe a bigger risk out there than the giant mindless robot going into reverse, which is foreign passive, or sorry, foreign capital. For the past number of years, foreign capital has flooded into the U.S. markets, right? The U.S. market makes up a greater share of the total global market cap than it ever has before. Um, we're now starting to see signs that that capital might be starting to leave, right? We're seeing foreign markets have outperformed the U.S. market last year, continuing, I think, to do so this year. Um, you're also getting. I know you would say this normally doesn't matter, and I would agree with you normally, which is that a lot of other countries aren't super psyched about the U.S. flexing its power. And we've seen things like you've scoffed at, right? The Danish pension fund or whatever it was saying, okay, we're going to take our money out of the U.S. market. And I generally agree with you that those types of threats are generally empty because I think capital will go where it's treated best.
Mhm.
But if all of a sudden you can get a better return in your domestic market or a foreign market outside the US, and you're not so happy about the US, all of a sudden the economics and your philosophies are starting to align. And you're starting to see in some countries, Lance, David was saying in South Korea, that they're actually having like a repatriation campaigns where they're saying, hey, look, if you bring your capital back here, we won't tax your gains. So all of a sudden there's a real, compelling carrot to consider doing this. So, David was just saying, hey, if you look at kind of the scale of it all, if foreign capital starts to start fleeing the U.S. markets, at a high enough volume in the next couple of years, that could be a bid or a reverse bid that could do potentially even more damage than the giant mindless robot going into reverse.
Yeah,
Curious
even
to
if that
hear
was
your
only
thoughts on
true,
that.
if it was only true, then that would be a really interesting story.
Okay.
So, but no, foreign assets are still flowing heavily into the US dollar and, just in a variety of assets. And look, what's been one of the best performing asset classes over the last few months that everybody's been raving about? Gold, right?
I was going to say gold, but I thought it
Yeah.
was a trick question. Okay.
Yep. Trades US dollars. So every time you buy gold, and this is the whole problem with the whole fiat currency. I want to get out of the dollar, so I'm going to buy gold. You're not out of the dollar, you're just buying dollars. And because gold trades in dollars, silver trades in dollars, commodities trade dollars, treasury bonds trade in dollars. So it's just a function of where you're moving reserve currencies. And so, yeah, I mean, if a country says, you know, look, you bring your money back and I'll waive all your taxes on your gains. You bet your bottom dollar, I'm going to move that money back right now. I'm going to get all my gains for free. And I'm going to turn right around and reinvest back into the US dollar because that's where money flows are going. Where's economic growth in the world? Is it in Europe? Nope, it's in the US. Where is economic prosperity? Is it in Europe? Nope, it's in the US. Where is AI development happening? Is it in Europe? Nope, it's in the US. So if you're a large cap manager or just a money manager anywhere in the world, where are you going to invest? Yeah, you can certainly put some money in China, no problem with that. Those assets are doing well. Sure, I'm going to have some assets in Europe, absolutely. But at the end of the day, if I've got to have exposure to the dollar for reserve assets or whatever it is, or if I'm managing currencies on international trade, I've got to have exposure to the dollar. I'm going to buy US dollar assets.
Okay, so that part's not going to change,
Yeah.
but what I'm taking from you is, hey, I'm not worried about this, at least not until I see real signs that it's going on.
Yeah.
Um, but just well, let's say the bloom starts coming off the AI trade in some sort of serious way, right?
Mhm.
And let's say that continued need interest in commodities, right? Well, there's lots of countries out there that produce these commodities
Mhm.
um, that actually have been doing quite well recently. So South
And
America, et
sure. And
cetera.
and when I
Um,
buy commodities contracts, how do I trade those?
sure, well, if you're buying it on a U.S. exchange, yeah, you're traded in
No, they
dollars.
all
But
they all trade in dollars. So when I'm buying futures, if I'm writing contract, look, there's three types of
Yeah.
speculators in the market, right? There's commercial hedgers. So if I'm Newmont Mining and I'm mining copper, I'm going to lock in my copper prices by writing contracts. That's a very small fraction of the futures market. Then you have the retail speculator in the market, which is a very small fraction of the retail speculation in the markets. The rest of the commodities markets driven by speculators, Wall Street, hedge funds, pension funds, massive commodity traders, that all trades in dollars. So again, it's fun. These narrative. This is the whole point. These narratives are great. They're great for spreading fear mongering and all that type of stuff. And oh my gosh, the world's going to crash. That's fine. These narratives are okay, but pay attention to where the dollars trade because this narrative that money's going to go flying out of the U.S. for one reason or the other, it's just not true because you're
Okay.
still just the predominant dollar currency reserve status in the entire world. So if
Well,
I'm
let me ask you
commodities, I'm
this.
trading in dollars.
You're making your point clear, and I'm not going to
Yeah.
fight it. But capital flows,
Sure, it
right?
does.
So capital
Absolutely.
flows into the
No.
U.S., good for U.S. stocks.
Yep.
Capital flows out of the U.S., not all the capital, but capital flows out of the U.S.
And,
That's
and that
not great for
happens.
stocks, right?
Right, right. And that happens all the time. If we have really weak economic growth and Europe is stronger economic growth, capital is going to leave the US to go to stronger economic growth. Right. So, no doubt about that. And that happens all the time throughout history. When you start taking a look at economic growth rates in 2026, 2027, 2028 for Europe, it's 1%.
Yeah, no, I agree. It doesn't look good in Europe. So let's do this just to cut to the chase.
Yeah.
I'd like to reach out to David, and who's the nicest guy in the world, unlike you, and say,
Exactly.
hey, Dave, ask him if he'd be willing to come on and have a 10, 15-minute
Sure.
conversation with you about this.
Absolutely. No, I'm not, and I'm not disagreeing with him, right? Capital flows, particularly when it comes into the ETF market, are extremely important because again, what's the one question we have always had is what breaks the passive flow? Because again, just every month people are just sticking money into
Right.
ETFs. It just keeps and 40 cents of those go into the mega cap stocks. So you've got to have something that all of a sudden reverses that trade. And if something happened in the US, as an example, that caused all of a sudden everybody else in the rest of the world says, I don't want my money in the US anymore. I want it back in, I'm going to shift all my money over to the yuan, right? Or I'm going to pull all my money back into Europe. That would be very bad for the US market because all those flows would come out of ETFs simultaneously. And then that would just cause every other asset's got to get sold off with it. So he's absolutely right that that would be very problematic. There's just no evidence that that is occurring as of now.
As in that, yeah, and just two things. As I see it, there are two risks, and they can happen at the same time, right? So a lot of like what Mike Green talks about with the robot it tends to be very domestically focused.
Mhm.
So in Mike's mind, the top candidate for sending domestic passive capital flows to flatline or go into reverse would be like a lot of a spike in unemployment, right? A lot
Mhm.
less people being employed,
Yep.
and therefore less capital needing to be reinvested, right?
Right. And
Uh,
that would reflect right back into your economic growth, like we're
Right,
talking about.
right. And that would, the markets would definitely react very negatively to that. And then, as you said, and then foreigners could then pull their capital out in addition to that. Oh gosh, your markets are getting beat up. I'm taking my capital, home, right? But
Yep.
those are two different things. So you could still have the giant mindless robot doing its thing, and foreign capital could decide to pull itself out as well. They don't have to be interdependent, although they probably would be.
Right.
So, anyways, let me reach out to David and just I know you're not saying this about him.
Oh no, no, and
And
I'm not disagreeing with him. I'm just saying that there's no evidence of
yeah,
that.
you're not seeing signs of it. I think he is seeing preliminary signs that make him concerned that it could happen. And I'd like to hear you guys sort of talk about that. But all I want to say is I know David very well, and this audience does too. He's not like a fear merchant. He's not trying to freak people out. I think
Oh
he
no,
has
no,
a
yeah, yeah,
I think he has a good faith effort concern here. And I would love
sure,
to
sure.
see you two guys explore it together. And if you find things to push back on, awesome. If he finds ways that you haven't been looking at to change your mind, awesome. We'll see what happens. Sounds good?
Yeah, 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 no
Okay.
problem.
All
Yeah,
right, good. All
no,
right,
no. Like I
last.
said, I don't disagree with him at all. I mean, this is going to be one of those conversations where we're both going to nod at each other. And, yeah,
No, no,
yeah,
no.
yeah.
You would say, hey, if it happened, I'd agree with you, David. I'm just not seeing signs it's going to happen
Right.
anytime soon, and that's what we can have the discussion about. All right. So one last question before we get to your trades, and then we'll do a rant to wrap it up. Increasingly, folks that I'm interviewing, Lance, are bringing up concerns about the credit markets and in particular private credit. Um, and they're whether it's things like the BlackRock, writing down 19% of its BDC funds, or struggles at what is it, Blue Owl. Um, so I'm just curious, what are you seeing in the credit markets right now, and what level of worry, if any at all, do you have?
Well, we just go back to looking at credit spreads in general, which right now they're just, yes, we've seen credit spreads rise here a little bit in some areas of the market, but nothing dramatic. And, again, if we start seeing a sharp increase in those credit spreads, we'll become a whole lot more concerned. But we have a
Yep.
lot of little one-off events right now that certainly concerning. But this is my whole problem with private equity, private credit. You know, when you invest in a private credit fund, as an example, they just mark to what they think. When you get your report each quarter, they say this is, and they go, this is what the fund is worth. That has not been marked to market. That is just
Right.
what they assume their value is. And so when something like this happens and there's a concern over some type of credit default, whatever it is, then all of a sudden they have to start writing that down. So all of a sudden you get this write down in the value. Is like, well, that probably should have been written down a year ago or 6 months ago, at least
Well,
the
here's the
early.
question. Do they have to? I mean,
No,
can they
no,
just,
and why would I? If I'm a private, so let's say you and I start a private credit fund, right? And so we raise
yeah.
$100 with our private credit fund because we're really bad at this. So we have a $100 private credit fund. Now, are we going to go issue out our next quarter that the fund is only worth $98?
No, and that's what I'm saying. Like what you said, if something comes out, they have to mark it down. Do they even have to then?
No,
Is it?
they don't. They
Yeah.
they that's this is what happens a lot of times is that
Yeah.
these values are what they assume. There was a private equity fund that was, and this was about 6 months ago, and they had everything marked up great, everything was wonderful, and then they got acquired. And when they got acquired, they revalued all the assets, and those
Yeah.
assets were about 50% of the value.
Yeah.
That's the problem. There's no visibility in this. And this is why, for God's sake, can we please have some regulatory oversight and not put these things inside of 401k plans? This
Or
would be,
pensions. This is a
or
huge pension
pensions,
issue.
right?
Yeah.
These needs to be as far away from those as possible. But, but just overall, right? When you're buying credit, you buy credit in companies that you can evaluate. And, for instance, Oracle has, I'm going to just pick on a couple of companies right real quick because they've been in the headlines. So
Go for it.
Oracle's been doing a lot of debt deals, right? Lots of concern over Oracle. Oracle has a debt to equity ratio of 4, right? That's pretty high for a company. Now, can they service that debt? Absolutely. They're probably, with a rating, probably double B, triple B, somewhere in there. But they can service their debt. So, but there are certainly concerns. When you got debt to equity of 4 times, that's a concern. Go look at Meta. Their debt to equity ratio is 0.19
Hmm.
with massive revenue flows. They could pay off all their debt tomorrow and it wouldn't even impact their free cash flow. So, when we're buying credit inside of our portfolios and we buy the actual bonds for our clients, we're doing that work, right? We're looking at the credit quality of the company, their debt to equity ratios, their fundamentals, their free cash flow, those type of things, and then also comparing their yield versus the treasury. So if I'm not, I've got to, if I'm going to take the credit risk of buying an Apple bond, for an example, then I got to look at Apple and say, what do they look like financially? Are they a good risk? But then also part of it is like if I'm getting 4.4% on an Apple bond versus 4.2% on a 10-year treasury, why take the credit risk? Right? I don't need to take the credit risk. I'll just buy the
Right.
treasury instead.
Right.
So, but this is the important part about managing your portfolio. But, just from a market perspective, though, now if we're worried about the markets, then pay attention to credit spreads. Credit spreads tell you everything you need to know. And right now, you look across the spectrum of B, single B, double B, triple B, single A, double A, triple A. Those spreads are compressed at very, very low levels. And yes, they've ticked up slightly, but not anything significant enough to cause concern.
Okay. I don't put words in your mouth, but would it be fair to say that you are watching the news and maybe feeling a little tightness in a little corner of your gut, but you're not going to worry about it or act on it until you start to see
Well,
credit
we
spreads
don't.
move?
I don't. I'm not worried about it right now because, again, from the portfolio management standpoint, we don't have any of that risk,
Yeah, yeah, I get it.
right?
I know you're not buying that stuff, but
Right.
I'm just talking from a market standpoint,
From a market
market integrity
perspective,
standpoint.
right. So from a market perspective, yes, we're watching those credit spreads, but they haven't ticked up enough to really
Right.
say we've got to be, we need to take some action.
Yeah,
It's
totally get
something,
that. I was just trying to
yeah.
get a sense. Are you like
Oh no, we're
I think
watching
there's a
them.
little fire behind this smoke, but I'm not gonna. I don't know for sure. So until credit spreads start moving, I'm not gonna worry too much about it.
Yeah, it's more of that. It's just we're watching it very closely and seeing if the story develops, right?
Okay.
This is
Yep.
this is the early headline, which is great. Again, we got to go back to just headlines and narratives, those type of things. These are great headlines and narratives. Gets lots of clicks and views and gets people really excited. But we need to see more consistency to seeing interest rates rise across the whole spectrum, starting to see potential a pickup in defaults, those type of things, and we're just not seeing that yet.
Yep. Got it. Got it. So you and I have talked about buy now, pay later in the past, and I think we both think it's you know the dumbest idea ever. In other words, it's just something that we have high confidence is going to come back to bite the issuers in the credit markets, right? Um, do you have maybe not quite as extreme, but do you have a do you think it's more probable than not, in the future, we're going to look back and be like, yeah, to let this private credit market grow as large and fast as it did with no regulatory oversight was probably
Yeah,
not a good idea.
yeah, of course. I mean, we go through this all the time, and this goes back to private credit earlier. We've got all this money chasing private credit, buy now, pay later, all this. Whenever that happens, these people have to allocate that capital. And so when I have a bunch of capital being thrown at me that I have to allocate, that means I start doing worse and worse deals. Right. It's like that's not a great deal, but I'll fund it anyway, just because I got to get the money off my books. I got to get it invested. Otherwise, I have to give the money back. So yes, definitely. At some point down the road, we're going to look back and go, well, yeah, that was obvious. That was all going to blow up at some point, just because of the function dynamics of how it works over time. And this goes back to why we should not put in 401k plans, et cetera, because
Yep.
that now you're just giving Wall Street another place to offload the worst deals,
Yep.
and that's in your retirement plan. So no, just say no.
All right, but let me put my Lance head on and say this is a lot like stock valuations. Um, while we can kind of have concerns about the probability of what's going to happen in the future, we don't have a sense of the timing. So this is not a reason to say, oh my God, I got to sell everything because the credit market's about to implode under private credit. We just don't know when this is going to happen. But to Lance's point, credit spreads will be a really good early indicator that there's trouble in the credit market.
Right, exactly.
Yeah.
And that's
Okay.
why, and just real quick, this is why on there, I'll just share this with you. On SimpleVisor, we actually track credit spreads every day. So this is charts of credit spreads. So this is the AAA historical spread of 20 years. We look at double A, and you're going to see the same thing in these charts. On the far right hand side, these are at the lowest levels they've been in like 20 years.
Yeah.
There's double triple B, here's single B, here's all right, and here's C. This is absolute junk, right? So,
Yeah.
you just cannot get more over 20 years. These are about the lowest levels they've been. So we start seeing these things tick up, like we saw here in 17, 18, back in 2007, 2000. I mean, this is the stuff you're looking for, or these upticks that tell you there's trouble in paradise.
Yeah. Lance, this may be a conversation for a different day when we have more time. We're not near the end, but why? Why are credit spreads the lowest they've ever been? I don't think that this is necessarily the safest, most tranquil period we've ever had in U.S. markets. Although I don't know if you disagree with that, let me know. But I guess my question is there something that is increasingly different about the markets that maybe suppresses credit spreads in a way they weren't
Yeah,
suppressed earlier?
absolutely. Uh, 15 years of bailing everybody out. I mean, for
Okay.
15 years, every time something blew up, we would, the Federal Reserve or somebody would step in and bail it out. I mean, look at what we did in 2020. The Federal Reserve stepped in with BlackRock and bailed out junk bond ETFs,
Hmm.
right? So didn't want to have those companies blow up and go out of business. So
Okay.
we basically suppressed the yields in junk bonds during 2020 to keep those companies in business. And so now that we've taught markets, and this is why you see so much speculation in the markets. You see, again, it's a shame because I've been, like I said, I've been watching my X feed over the last couple of days, and just the number of people that have blown up their entire portfolio because they were leveraged long 4 times, silver, and it
Dogecoin.
goes in the other direction, it just completely wipes you out. You know, and it's funny because when we talk about it, we say, don't do this. They go, oh, you're a boomer. You don't understand. This time is different. Yeah, I've only seen this happen out multiple times over time.
Yeah.
It always ends the same. But we've now taught everybody that there is no risk of taking risk. And this is why when you take, why not buy an 8% C-rated bond? There's no risk in doing that. I can get 8% if I buy a C-rated bond. I can get 8% on my money. And as long as they get bailed out, I'm in good shape.
So is it fair to say then that while there's still a very important indicator, an early indicator, that credit spreads may not be as reliable as they were in the past, that maybe they might be a little bit slower to move to danger than they were because you have to convince everybody who's just assuming there's always going to be an immediate bailout?
I don't know the answer to that, to be honest with you.
Yeah.
My suspicion is that when it breaks, it all breaks at once and it
Hmm.
moves very fast.
Okay. All right.
And
Well,
then the
look,
Fed steps in and bails everything out again.
right, right.
So
Yeah, I mean, I don't. Yeah, we're
that
neither of us is expecting a different playbook from.
exactly. I mean, but the answer, I don't know how it's going to move. But my suspicion is that when it moves quick.
Okay. All right. Trades, we'll get to our rant. And with the rant, I ask a very important existential question. Very curious to hear your answer to. But
Okay.
trades, what trades have you guys made, if any?
Only trades this week were we did. So we launched early this year the factor rotation model, which switches from value to growth,
Yep.
and then from growth back to value. And so when we launched that portfolio,
Sorry to interrupt, but before you go, is it just growth to value, or is it's switching out of whatever is up in the high right-hand quadrant to what's in the low-end quadrant?
no, no. So the way the factor rotation model works is it looks at the value index versus the growth index.
Okay.
And we have about 18 different metrics that determine when that rotation is changing. So in other words, growth stocks are going to outperform value or value is going to outperform growth. When the model changes, it moves from 80% of one to 80% of the other. So there's always 20%. Like for instance, right now, as of last week, we launched it. Uh, Sorry, let me rephrase that. We launched this portfolio back in January. It was 80% value, 20% growth. So it owned the
Hmm.
Palantirs and the NVIDIAs, but very, very small weights. Now, as of this week, and particularly as of Tuesday, that those 18 indicators have now all switched, suggesting that value is now ready to start rotating back into growth, which we're actually seeing today in the markets. So that portfolio switched from 80% value to 20% value and from 20% growth to 80% growth. So now it's weighted on the growth side of the component. And what those indicators are telling us is that we now should see here over the next few months that we should see growth potentially outperform value. Now, these
Outperform.
rotations, now here's the important thing about this. These rotations can last anywhere from 23 days to 435 days.
Okay.
So we might be in growth for 2 weeks, we might be in growth for 2 years, right? It
Got it.
just
Yep.
depends on where the signals work.
On what the indicators tell you. Okay.
Right.
And is
But
it only 80/20 or 20/80?
yeah,
In other
there's
words, you don't go 50/50 or 40
no,
60 along the
it's
way.
the
Okay.
way the model, we back tested this model for like 25 years. And so the way it works is it's one or the other. Now we're going to launch another version of this potentially we're working on right now that will actually include fixed income and cash as part of those switches. So it could actually then go from 80% value to 20% growth and 40% cash or whatever. So we're working on that modeling now.
Okay. So it'll breathe two ways, value and
Yeah,
growth, and it'll breathe in or out of the market.
correct.
Okay. All right. So sorry, you were talking about trades. So that's what, now gone live, or what's the news around
Oh yeah,
that?
no, we launched that portfolio back in January. On January the 1st, we launched that portfolio. It's a live model. I funded it with
Yeah.
100,000 cash, and then it's been trading live since then. And so on Tuesday, we did that switch. So we had like 60 trades that occurred one day.
Okay,
Uh,
guys. So the news is the model flipped. Okay.
the model flipped, yes. But outside of that, we didn't make any other changes.
Okay, great. All right. All right. Well, look, now let's get to the rant. I'm working up to a very important question. But I'm going to start with first a little celebration. So, Lance, yesterday, as you probably know, I work out and I've been chasing a four plate deadlift.
Okay.
So four plates on each side of the bar. That's 405 pounds. I've been, for a while now on the hex bar for deadlifts. Anyways, I finally lifted 405. I'm putting up a quick video of it here.
Okay.
And I was going to make this rant about goals, but I'm not actually. I'm going to make it
Why not?
more.
That's a good goal.
Thank you. Yeah, it took. I mean, I've literally had the desire to lift four plates for, I don't know, over a decade or whatever. It's very cool to have finally hit it. But going to make the rant about getting comfortable with discomfort, even extreme discomfort, because that's really what progress is a result of, right? To be able to lift those four plates. I had a lot of time in the gym, struggling to push myself to always try to get a little bit stronger, right? And so I mean, Lance, you've been a gym guy, right? You know the whole no pain, no gain, right?
Yep.
You don't get where you want to go in life without having to push yourself to get there. And a huge part of that is just really understanding that pain is, as long as you're not injuring yourself, right?
Which
That
is the important
pain
part.
is the price of progress, right? And that pain is something that can be endured, right? There's the old saying, whatever doesn't kill you makes you stronger. But anyways, I want to encapsulate this in a little story. So when I was in college, I had a period where I was getting strep throat an awful lot, and so I think it was right at the end of the summer. I had strep throat. I went back to college. That year, there was like an outing, out in the wilderness. It was like a 4-day outing. And so I was just finishing whatever antibiotic they gave me for the strep and went out on this camping trip and finished it, but it wasn't enough to kill the strep. So when I was out there in the woods, it came back. And I was, away from hospitals and doctors and whatnot. So by the time I got back from this camping trip, I just had this raging case of strep. Couldn't open my mouth. It was like having to talk through gritted teeth. And when I get back, they went to the doctor. He said, "Oh my God, you got to go to the hospital and have them take care of this." So went down to the hospital there in Providence, and the doctor said, "Oh my God, this is pretty bad." And he looked in the mouth and he said, "God, you've got a huge infection inside your mouth. It's not just in your tonsils or in your throat. It's all over your mouth. And I'm going to have to lance it. I'm going to have to literally get in there and
Oh,
just squeeze all the pus and everything out of there."
ouch.
He said the problem is like it's all in the roof of your mouth, right? Which is basically just bone, palate, and then just a whole bunch of, sorry for the graphic details, folks, but a whole bunch of pus underneath it. He said, "There's nothing for me to put an anesthetic in there." So he said, "Dude, you're going to have to just white knuckle this. I'm gonna get a scalpel in the back of your mouth, cut the roof of your mouth, and then just push all this gunk out of you."
Oh, Jesus.
So, I'm sitting there as he's doing it, and Lance, this is like the most pain I'd ever experienced, and I have to just take it. Like I have to keep my mouth open and let him get this, let him do the work he's got to do in there. And I remember my brain just trying to claw its way out of my ears and escape. It was like an out of body experience. But what I took from that was, oh my God, like that was a maximum on the pain scale. And, I survived. And just FYI, folks, I ended up having a tonsillectomy. And fortunately, since then, really haven't gotten strep again. Um, but anytime that I had to deal with something that was very physically, uncomfortable, I could always compare it to that and say, well, okay, it's not nearly as bad as what that thing was, right? And it's helped. It really has helped me get through an awful lot of stuff, like the other time in the gym, like I'm tired or this hurts or whatever, but like, okay, it's not as bad as that dude with the scalpel up in my mouth there. Um, so So first off, I think the ability to get comfortable with discomfort and realize, as long as I'm actually breaking bones here or doing real damage, like pain is just something that will go away eventually. And I can either soldier through it to get to a greater goal, or if something is happening to me that I don't like, I'm not going to let it I'm not going to fall to pieces because of it, because I know that if I
Right.
just endure through it, it'll be in the past and I can get on with my life. So I'll take a beat here. There's more to this, but I want to take a beat here and just let you respond, Lance, because I think you've had a life where you've had a relationship with pain like this too, where you've found that, hey, if I can just get through it, it filters out a lot of people who can't, and it's a
Mhm.
big, like I said, almost sort of a superpower.
Well, no, this is so first of all, when I was training in martial arts, I had this Korean instructor. He used to train the Rock Army back in the day, and he was brutal. And he would, while we're practicing, he'd walk around with this big bamboo cane, and he would whack us on the shins constantly, just to toughen the shins up. And we had to, and he just, there was a lot of things we did that were extremely painful, but it was to strengthen the bones and really just build that kind of mental toughness. Because once you get in
Yep.
the ring, you've got to be able to endure the pain of the fight, right? And this is, the one thing that it's always interesting. I see people, they're like practicing self-defense. And so they'll go to a self-defense class and like, oh, I took self-defense. That all goes right out the window as soon as you get smacked.
A
Um,
thousand percent, a thousand percent. Yeah.
and Mike Tyson says like, best laid plan goes to hell as soon as you get a punch in the nose. And so you have to learn, kind of what that, how to endure that pain so you can stay on whatever plan you is. But, for people, right? And for individuals, we talk about this a lot. And one of the most frustrating things for me right now is I see all these emails from the younger generation, the Gen Zs and the millennials, and they're like, life is so unfair. This is unfair. That's unfair. Home ownership is unfair. This is, and like, hey, I get it. I completely understand that. But you have a choice. And in fact, I'm writing an ebook for this right now. I'll have this ebook out hopefully in the next couple of weeks, but it's called The 10 Immutable Laws of Money. And all these challenges are pain and they're painful. And you have a choice. You can either blame everybody else for why you're in your predicament and allow the pain to overtake you, right? Just I don't want the pain, so I'm just going to quit. I'm just going to just not do this. Or you can take the other route, which is to endure the pain and do what's necessary to achieve those goals. And this is what the 10 immutable laws of money are about, is just going through these things that you have to start thinking about sacrificing and enduring and doing these type of things to really build wealth over time. And there's nothing stopping you from being successful, achieving your financial goals, achieving your business success. But what happens for most people, and I can tell you this from personal experience, I've had businesses I've started that have failed, flat on my butt, had to start all over again. And where normal people would quit, I just had this key. I was like, okay, well, it happened. Here we go again, and did it over again. And those setbacks are always painful. They hurt a lot. They're very disjointing. But if you can get through that, A, you learn a lesson. Okay, I'm not going to do that again.
Hmm.
And B, I now know what to be on the watch for next time to make sure that doesn't happen to me again. And so this is so the to your point, and I think it's a very valid point, it's a very good point, is that no matter what your situation is, A, don't adopt a victim attitude. That's the word that is basically just giving up. As soon as you start blaming other people for your problems and not accepting responsibility, you've already given up.
It's
And
guaranteed failure. Yeah.
yeah, and so the best thing to do is even if Adam slights me, right, and or does something to me and he hurts me somehow, I'm not going to blame Adam for that. I'm going to blame myself for letting Adam do that to me for whatever it is. And so in other words,
I
accept
know you, Lance, you're going to do that, but after you punch me in the nose first. But
correct,
yes.
exactly. But my point though is that it's really easy to blame other people for our situation. But if you will step back and just say, accept responsibility for it, say, okay, this happened. I'm probably at fault for letting this happen, right? Even though they did it to me, I let them do this to me. It allows you mentally to accept your situation and to now look forward and say, okay, I got myself into this mess. How am I going to get myself out? Like my daughter always says, the best rescue is a self rescue.
Hmm. Smart daughter. So great, Lance. Agree with everything you said. Folks, I did not know about this top 10 rules of wealth or whatever that Lance was writing here. So I promise this wasn't an intentional softball that I tossed to
Yeah.
Lance here. Um, so yeah, so my advice to folks, which I think is yours too, Lance, which is get comfortable with discomfort because so many benefits come from being able to persevere, right? And it's funny, like when you think about our ancestors, our caveman ancestors, like their life was like 99% discomfort all the time. I mean, they would look at what people are bitching about today and be like, are you kidding me? Right? There's nothing waiting to eat you right now.
Exactly.
Yeah.
I'm gonna go to work today. Don't get eaten.
Yeah. So okay, so that's the benefits of persevering through discomfort. There's another edge to that sword though, and that is I have definitely well, I think this is a strength of mine. It has also been a weakness of mine where I have stayed in situations for far too long. I have endured things for way longer than I should have. Lance is raising his hand as I'm saying this.
We
Um,
all do.
yeah, whether it was relationships before I found my wife, whether it was jobs that I had, business partnerships that I should have left long before, um, or just I mean, injuries. I've had things where, it just hurt and I just dealt with it. And then, like a year or two later, when I still had this chronic pain, I was like, well, why have I not gone to the doctor yet and just gotten this addressed, right? Lance again is grimacing
Yeah.
here. Um, so the important thing here is you need to, in addition to the physical part and the mental part of like, okay, I just got to grit through the discomfort. You also have to have some active thinking to say, okay, but is this worth it? Like, is this discomfort that's getting me towards a goal? Is this just a hard slog towards a better place? Or is this just wasted effort, right? Am I just grinding gears that aren't going to get me anywhere good, right? So it is very important as you're dealing with discomfort to make the distinction, right? And obviously persevere on the stuff that's going to get you somewhere good and bail on the stuff that's not going to help you out in the long run.
Right.
Okay, so Lance, now that I've got both sides of this, here's the question I've been leading up to.
Okay.
So when I travel, when I fly, I'm pretty much because I'm just such a frugal bastard. I'm pretty much the guy who goes to Expedia, finds the
Mhm.
cheapest ticket of where he wants to go, and buys that ticket.
Yeah.
And a lot of the time, I end up with where when I was coming back from your conference at Houston, where I'm stuck in the back of the plane in the middle seat, right? And the way I think about it is, look, back of the plane gets to the destination the same time the front of the plane does. It's just a couple of hours, right? I'd much rather just get the cheapest ticket and just, go to my happy place in my brain and gut through it all, and then have more money to either compound and grow in the future or to spend at wherever I'm going to, right? So I posted a video or a picture of me in my uncomfortable seat when I was flying back from Houston and got a lot of sympathy from a lot of nice people, but I had a surprisingly high number of people say, "What are you doing?" Like, I never fly, coach. Like flying is the one thing I refuse to be really inconvenienced on, especially if I'm a taller person or whatever. And I at least pay for premium economy, but no, when I fly business or I fly, more than that if I can afford it. And I realized that there really is sort of there are two
Mhm.
different types of people when it comes to traveling. One like me who just says, look, it's just time in a bus and I'm going to get the cheapest way to get to where I'm going to go and save the difference. And other people who say, man, life's too short. And this is one of the things that I just always make sure I'm not sacrificing. So I'm curious, do you have a strong opinion on this very clearly important existential debate?
So this is so important. First of all, it is very important that when you're in the back of the plane, you are the last person to the scene of the crash.
Okay.
Now, having said that, no, I'm the same as you.
That's dark.
When I book flights, I book the economy class. I'm back there with you because again, this is one of the 10 immutable laws of money, which is don't let leakage interfere in your savings and investing goals. And this is how we start to justify things, right? It's like, oh, well, I'm gonna cut over here, I'm gonna cut out my coffee, but I'm gonna spend an extra $2,000 on this plane ticket because I want to fly first class, whatever it is. That's fine. That's your choice. But again, I'm very much in your camp that it's just a flight. It's 2 hours of, like when I go to New York for interviews or whatever, it's 3 hours of my flight. I get in the back. I just sit where I sit. Write notes for my speech or whatever I'm doing, or I'm working on a blog post. It's 3 hours of my life, and it's not worth spending that money that I could be investing and making a lot more money with. So yeah, I'm absolutely in your camp because normally I find that people that are splurging on, airline seats, etc., they're also splurging in a lot of areas of other life, going, well, you only live once, you always do these type of things. And that's once you start adding all those things up, that's what impairs you from reaching your financial goals.
So I totally agree, and particularly if you're younger, absolutely. I think everybody should be taking our way, Lance. I'm not necessarily here to say that my way is the best
Oh,
way.
no. It's just the
And
way I
I'm
do
sure
it.
my wife, doesn't necessarily see it as well as I do. I'm sure she'd love some upgrades in there at some point in time. And I also realize too, part of this too, is influenced by miles. And because I don't use credit cards, I don't
Mhm.
get miles, and I know I'm giving up, those perks. And so
Right.
you can get better seating without necessarily spending extra cash to do it. Um, but I also like part of me also does get the like, all right, guys, I hear you, but like if let's say somebody here is in their 60s and they're pretty good at they're on track for their life goals. For them, they just might say like, "Hey, Lance, the money is a means to an end, right?" And
Sure.
for me to be able to travel and not feel like I'm just crammed in as a piece of cargo, that actually is something that brings me a lot of joy in life. And a business class ticket's not going to kill me if I have one or two of those a year. It's not going to derail me. So like I kind of get that too.
If you are financially squared away, then yeah, go for it.
Yeah.
Fly private. At some point, I'm going to sell my business and forget commercial. I'm going to fly private because I'll be able to afford it at that point. So yeah, I mean, if you get to the point to where, and this goes with all things, right? This goes with everything you're doing. I don't pay for my kids' college. I make them do that. So a lot of parents they go, yeah, but I want to pay for my kids' school. I feel like it's my responsibility. Cool, on you. That's your choice. However, if you pay for your kids' college and you wind up using, not reaching your retirement goals because you spent all the money paying for the kids' college, great. You're now a burden on your kids. You're gonna have to go live with your kids in retirement.
Yeah.
That's not really what you want. So I don't care what you spend your money on. And yes, if you've done a great job of saving and investing and doing all those type of things, and you're now in a very good position financially, and you can go drop 15 grand for a business class ticket, go for it. Right? Awesome. That's what you did all this work for, right? This is what we are talking about earlier about, reaching goals and doing those type of things. But the effort, to reach that financial goal was flying economy, right? That's the pain, right? I'm gonna subject myself to this pain so I can save and invest and reach my goal. And once I reach that goal, guess what? Now I can fly first class if I want. I can, buy fast cars, fancy cars. I can do all those things because now it doesn't affect my end goal because I've reached my goal. The problem
Yeah.
for most of us is we're flying business class when we're still trying to save, and we're buying,
Yeah.
G wagons and $80,000 cars because we want to look cool, and a car just gets us from point A to point B.
Yeah. Yeah. You're flying business class on an economy income.
Yeah,
Yeah.
exactly.
Yeah. All right. So
So it's
this,
just choice. It's just choice, Adam. At the end of the day, it's just choices, and how you live your life and how you do things. Totally up to you. But that's the whole premise behind this ebook on 10 immutable laws of money, is just helping you think through the choices you make.
okay. Well, look, when the book is available, obviously Lance will make ample time in whatever weeks recap that it comes out in where you can, tell people about the key tenets, but also where to go get it.
Yep.
Um, and I'm also thinking a fun discussion to have with you at some point too would be, uh, enjoying the journey along the way.
Mhm.
So, I mean, you and I are a bit older, we're doing fairly well. But like with my wife and I right now, like we are really trying to be more planful about creating experiences,
Mhm.
during the week to say, okay, like let's get out and let's like we just took a cross country ski lesson the other day, or we're going to go for a hike with the dogs or whatever, right? We're trying to create the space because otherwise, I'm still so locked in
Yep.
on working pretty much all the time to not just run thoughtful money, which takes an awful lot of bandwidth for a one-man show, but also to try to grow it too, right? So, if left to my own devices without a nice little reminder or me boxing the time off on my calendar, I would probably just work all the time, right? And
Yep.
and
Both.
and that's me taking the pain to get to a better
Mhm.
place down the road. But there's no guarantees, right? I might get hit by the bus tomorrow, and I want to make sure that I say, okay, look, I lived enough of my life along the way to have enjoyed it, even if, my time here is cut short. So I do want to talk to you at some point about, how do you find the right balance? How do you juggle between the two? But I think that's a longer discussion than we
Yeah,
have
yeah.
time for
But
now.
no, and just real quick, just to your point, absolutely agree. And I tell you what, and I talked about this before with you, is that, I am just like you. I am nose to the grindstone, 7 days a week. I work every single day of the week on my business. And that's the way it's been for 25 years. And when my wife got cancer, that changed all that
Hmm.
because she also works. She has a very good job. She does very well at her job. She works all the time. She travels a lot. But that really brought into focus this, importance to your point of spending more quality time together, enjoying the life that we have, doing things together. So we're making a lot of plans now that she's through chemo, and thank God it all went fantastic. She's no evidence of disease at this point, so
That
the,
is so
the
great.
outlook couldn't be better. But now we can get back to living our lives. But again, we don't know how much, what that brought into focus was is that we never know how much time we have with each other. And so we need to value that time. We always take it for granted. Oh, yeah, honey, you'll be here tomorrow, right?
Right.
It'll be fine. But when something like that happens, you really realize that time is very valuable. So, to your point, it is very important to certainly live and do things and do experiences that are important, but that doesn't mean you have to spend a lot of money. Again, this is one of the things in the 10 immutable laws of money is that there's a lot of things you can do in life that are absolutely free, and the time and what's important is not what you're doing, it's that you're spending time with the people you
Exactly.
love.
Exactly. Yeah. 1,000% agree. And in fact, when you think back, I mean, just think back on your most memorable, fond experiences in life, Lance. I'll bet very few of them you were spending a ton of money doing. And it was just, hey, I was out with
Yep.
so and so and we had a really great time, right?
Just a funny, just quick story. One of the fondest memories of all my kids and me and my wife as a whole is that she went down to Walgreens and bought like 12 cans of that Barbasol shaving cream, and the kids had a shaving cream
Shaving
fight
cream fight.
in the
Yeah.
in the front yard. And that one memory that cost us maybe $12 at the time or
Yeah.
something. I mean, it was meaningless, but they had so much fun because they were covered head to toe
Yeah.
in
Yeah.
shaving cream, right? And I've got pictures of it and all this stuff. But that is the one memory. Whenever they talk about being kids, they all remember
Remember
that
that.
very vividly. And that was, again, it cost nothing for a memory that they still remember today.
Yeah, yeah. Such a great point. Okay. Well, look, let's end on this. So again, we don't know how much time we have on this planet, but there are elements of that timeline that are in our control. I just got we talked about the concierge doctors. I think both of us
Yep.
now use, but mine's been going through a checklist. I just did the last big thing, which was I got my colonoscopy, and again, back to kind of like soldiering through discomfort. Yeah, especially the prep wasn't super fun, but it was nothing compared to the big challenges of life. It was absolutely nothing.
Yeah.
And now having the peace of mind that things are generally pretty darn good. They found one polyp. I'm going to wait. They biopsied it, so I'm waiting for the results. But nobody seems worried at all. But more importantly, beyond that, everything looks just fine. And just concluding with an important PSA, invest in your health. A lot of the stuff that I've talked about on that list, I think the heart CAT scan cost me $120. I think I don't think I had to pay necessarily anything for this colonoscopy. I think it was totally covered by just my general healthcare. So, a lot of these very important diagnostic things that are very important to prevent against things getting worse down the road. They don't cost that much money, and they can make a really big difference in increasing the amount of time you have left here on this earth to enjoy the things that you want to do. So, folks, if you haven't gotten, a colonoscopy and you're in the right target age, go ask your doctor about it. All right, my friend Lance, it's always great. Folks, if you think one of the absolute best things you can do to enjoy the time you have left on this earth is to continue to watch Lance Roberts on this channel with me week after week, please let him know that by hitting the like button and then clicking on the subscribe button below if you haven't already, as well as that little bell icon right next to it. If you would like to get some help from a professional financial advisor for positioning your wealth for the type of year that may lie ahead here, as Lance and I have discussed, I highly recommend you get that advice from a good professional financial advisor. If you don't have one that's already advising you, feel free to talk to one of the ones that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. The firms will be in touch with you right away. Also, lastly, can't forget to mention this, Thoughtful Money's spring online conference is coming up. It's going to be next month on Saturday, March 21st. I had meant to print out the list of the speakers. I'm sorry, folks, I keep forgetting to do that, but it is by far our best list of speakers ever. Very quickly off the top of my head, Lacey Hunt is doing his regular graduate level keynote to kick it off. We'll then have Luke Roman, we'll have Brent Johnson, we'll have Ed Dowd for the first time, we'll have Matt Taibbi here for the first time, we'll have Judy Shelton, we'll have Danielle DiMartino Booth, we'll have Michael Howell talking about liquidity, we'll have Darius Dale, we'll have Rick Rule going through his top resource stock picks, we'll have Melody Wright talking about housing, David Hay will be talking about international investing and income investing. I think there's one or two more that I might not be remembering right now, but you can get all the details about the conference and buy your ticket over at thoughtfulmoney.com/conference. But folks, you can tell that is an incredible lineup of speakers. It's going to be over 10 hours of content. If you can't watch live on Saturday, March 21st, don't worry. Everybody who signs up for the conference will also get a replay video of the full event, all the presentations and all the live Q&A. And we're pretty good about getting that replay to you within just a couple of hours after the event's conclusion. Let's see what else. Well, I guess that's it. So folks, anyways, make sure you sign up for that. Oh, that's right. Make sure you sign up for it now so you can lock in the lowest early bird price that we're offering. And if you are a premium subscriber to our Substack, check your email. I've sent you a code. You can use that code to get an additional $50 off of that lowest early bird price. And if you're not a premium subscriber to the newsletter yet, you might want to think about becoming one because it's only, I think, 19 bucks a month. So if you want to game the system and just subscribe for a month, pay your 19 bucks to do that to get the $50 off the conference, well, you can pocket the difference, and I'm totally happy with that. All right, my friend Lance, I'll let you have the last word here as we wrap up.
Nope, that's pretty much it. So we'll see how this week plays out, and we'll be back here next week.
All right, buddy. Thanks so much again. Just so phenomenal to hear things are going so well for your wife health-wise. Appreciate you being here on this channel with me week in and week out, and look forward to seeing you next week.
Absolutely. Look forward to it. Thank you.
All right, and everybody else, thanks so much for watching.